Most people think the hardest part of buying a home is saving the down payment. It's not. The real danger comes after you sign the mortgage. Because a mortgage isn't just a loan. It's a 30-year financial contract filled with fees, incentives, and traps most borrowers never understand. Today, I'll break down mortgages in plain English, how they really work, where people get quietly overcharged, and how to protect yourself before signing anything. If you ever plan to buy property, this video can save you tens, sometimes hundreds of thousands of dollars. What a mortgage actually is. Let's start simple. A mortgage is a secured loan used to buy property. The house itself is the collateral. That means if you stop paying, the bank takes the house. Until the loan is paid off, you don't fully own it. You're essentially renting money from the bank and paying interest for the privilege. Sounds basic, but here's the part most people miss. A mortgage is not priced to help you buy a home. It's priced to maximize long-term interest revenue. Everything else flows from that incentive. The three core parts of every mortgage. Every mortgage has three core components. 1. Principal. This is the amount you actually borrow. If the home cost $500,000 and you put down $100,000, your principal is $400,000. Simple. 2. Interest. This is the cost of borrowing money. But here's the trick. Interest is calculated on the remaining balance, and early payments are mostly interest, not principal. Which means, for years, you're barely reducing what you owe. 3. Term. This is how long you're locked in. 15 years, 20 years, 30 years, or more. Longer terms equals lower monthly payments, but much higher total interest paid. Banks love longer terms. Borrowers love smaller monthly numbers. That mismatch is where trouble begins. Fixed versus adjustable mortgages. There are two main mortgage types. Fixed rate mortgage. Interest rate stays the same. Predictable payments. Boring, but safe. Adjustable rate mortgage, ARM. Low rate at the start. Rate changes later. Payments can jump suddenly. ARMs are often marketed as smart for people who won't stay long. But here's the risk. Life changes. Markets crash. Refinancing may not be available. Many people trapped in past housing crashes weren't reckless. They were sold flexibility that disappeared. If you value certainty, fixed rate wins. Why monthly payments are a trap. Banks don't sell mortgages based on total cost. They sell them based on, can you afford the monthly payment? That framing hides reality. Two loans can have the same monthly payment, radically different total costs. Example, 30-year loan at lower payment, 15-year loan at higher payment. The 30-year loan may cost double in interest. Monthly comfort today often means financial pain tomorrow. Always ask, how much will I pay in total over the life of the loan? That number matters more than the monthly one. Amortization, the silent wealth drain. Let's talk about amortization, the schedule that decides who benefits first, you or the bank. In most mortgages, early payments equals mostly interest. Later payments equals mostly principal. For the first 5 to 7 years, you build very little equity. You're paying mostly rent to the bank. This is why selling early can feel disappointing. Refinancing resets the clock. Banks still profit even if you exit early. Understanding amortization explains why mortgages are so profitable. The hidden costs nobody explains. Your mortgage payment isn't the full cost. Watch for origination fees, closing costs, appraisal fees, title insurance, mortgage insurance, escrow requirements. Individually, they seem small. Together, they can add tens of thousands. Some lenders roll these costs into the loan, which means you pay interest on fees. Always ask for a full loan estimate, line by line. Confusion is expensive. Clarity is power. Refinancing, tool or trap? Refinancing sounds smart. Lower interest rate, lower monthly payment. But refinancing resets amortization, adds new fees, extends the loan timeline. People refinance multiple times and end up paying interest for decades, barely touching principal. Refinancing only works when the rate drop is significant, you shorten the term, you'll stay long enough to break even. Otherwise, it's just a reset button for the bank. How banks actually make their money. Here's the uncomfortable truth. Banks don't win when you pay off your mortgage early. They win when you take long terms, refinance often, focus only on monthly payments. That doesn't make banks evil. It makes them incentive-driven. Your job as a borrower is to minimize interest, control the timeline, understand every clause. A mortgage can be a tool or a leash.
The Smart Borrower Checklist. Before signing any mortgage, ask yourself, do I understand the total cost? Am I choosing comfort over control? Can I afford extra principal payments? What happens if my income changes? Would I still be okay if rates rise or values fall? A home should give you stability, not financial anxiety. The smartest borrowers don't rush. They read, they calculate, and they never sign what they don't understand. Final words. Mortgages aren't inherently bad, but ignorance is expensive. If this video helped you see the system more clearly, you're already ahead of most buyers. Subscribe for more financial breakdowns. No hype, no selling, just clarity in a world designed to confuse. Because the best defense against getting tricked is understanding the rules before you play.